Most account managers don't realize how much their renewal and expansion forecasts shape next year's headcount, critical funding, and product priorities. But Cliff Unger does. As a former chief revenue officer, he has led revenue strategy across startups and scale-up companies, and he knows how numbers from the front lines shape decisions in the boardroom. In today's episode, Cliff explains why bad news early is better and how to deliver it right, what CEOs and CFOs really do with your forecast, and how account managers can become credible operators within the business, not just advocates for their customers. This episode pulls back the curtain on how your renewal forecast shapes hiring, budgets, and boardroom decisions, and what happens when your forecast is off. I hope you enjoy my conversation with Cliff Unger. If you're an account manager, you already know this. You're the one keeping the business running. You own the client relationships, drive the revenue, and solve the tough problems for your customers. But here's the challenge. Most companies don't give account managers the training or recognition they deserve. That's what you'll get here on the Account Management Secrets podcast. I'm Alex Raymond, and after working with thousands of account managers, I know what separates the best from the rest. In this show, we cover exactly what you need to succeed, handling tough client conversations, driving renewals and upsells with confidence, and proving your value every single day. There's no fluff, no outdated sales tactics, just real practical strategies you can use right now to grow your accounts and build a successful career. If that sounds like what you've been looking for, hit subscribe and let's get into it. Hey, Cliff, great to see you. Thanks for joining me.
Alex, good morning. How are you?
I'm fantastic. You and I met, we were just realizing you and I met 10 years ago, and you've had quite a trajectory in your career. And I want to share with people, why I invited you here on Account Management Secrets. When we first met a decade ago, you were at a software company here in Denver doing account management. So you had
Ready Talk,
Denver
darling, if you will.
Yeah. And you had transitioned from the hardware world into the software world and account management role. You then had all these sales leadership positions. You worked for tons of cool companies. Most recently, you were chief revenue officer at Snap. So it's cool to think of, how people can go from an account management role into new business sales, into revenue leadership. I think that's a really, really cool story. You also have seen multiple sides here. So you have experience both on the hardware side, kind of classic account management, and then the SaaS or the software business models where everything is about renewals and landing and expand business models. So yeah, super, super interesting. Walk us through kind of that transition. What's different in your mind between hardware-based account management, so hardware companies versus software and SaaS models? Let's start there.
Yeah, great to see you. Wow, that takes us back, 10 plus years. I think you were just vetting out some ideas for CAPTA at the time and how it applied to the type of business we were doing at Ready Talk.
Yeah.
I made the deliberate move to software. That was like late 2012, early 2013 is when I joined Ready Talk. I just moved back to Denver from LA. But before that, to your point, I spent most of the early part of my career in, traditional IT hardware, if you will. Graduated from college. First job out of school was selling into the data center, data center racks and enclosures and cooling systems and UPS, et cetera, and then evolved through a few iterations to the role I was at just before I joined Ready Talk, which was at Belkin International, consumer electronics manufacturer, and a big, really, unless you're in the space, kind of unknown business in commercial IT. Account management in that world and kind of the early part of my career was about really, really long-term relationships. Like in the SaaS universe, or when we think about software, a really long-term relationship might be, hey, I got a 3-year contract or a 5-year contract. But a lot of that business, the business I previously was a part of, runs through distribution. So yes, there are often end user customers that you work directly with. So when I was at Belkin, our commercial sales and account management organization oftentimes was creating end user demand or finding the next data center project or government, kind of switching project or whatever the case might be. But most of that business is fulfilled through distribution or reseller partners. So account management in that world is not necessarily always even about the end user and are they getting value out of your product, the way we think about it in a SaaS universe. It's about truly being an account manager. How do you manage the relationship? Are you responsive to them? Do you provide value? A lot of these resellers, I can recall when I was at Belkin, our team, in any given month, Belkin products would be sold through around 8,000 or 9,000 different value-added resellers across the country. That's just North America.
Huge number.
But not always the same 8,000 or 9,000. There were probably 16, 18, or 20,000 resellers that had sold a Belkin product at some given time. It just depends on who has what project that has a need for that part or solution, et cetera, et cetera. Account management in that universe is consistently adding value, not necessarily even your product adding value, the way that we think about it in SaaS, like first time to value, full time to value, full value. It's adding value as a partner. So, it wasn't uncommon that we were spending investment dollars. We called them MDF or marketing development funds. The days of distributors and resellers buying at one price and then making a margin and that's how they made money were long gone by then. Yes, that was a part of it. But we thought in terms of like overall wallet margin. So they made a certain amount of money on like buying at one price and selling higher, like, putting a markup on. But then the other they made from manufacturers like us investing in marketing development. In the retail world, it was things like the Sunday Circular, where Best Buy is advertising a discount on routers or surge protectors or whatever the case might be. In the commercial universe, it was outbound, or it was your distributors or resellers getting in front of end user customers. So they thought about CDW for their next data center project instead of some other reseller, as an example. Account management for us was being present, being valuable, and consistently making that partner more educated and informed on how to deliver a solution for their end user, which is like the corporate, IT end user.
So you're almost like helping them build their business. Like you're there teaching
100%.
them how to grow, how can they use your product and your solutions to increase their margins, to grow their business and to expand. So you're really in the business with them.
You're 100%. And going back, 12, 13 years ago, yes, obviously people had access to a lot of information, not nearly the scale of information that they have today. So going back even to date myself, going back even further, around 1999, 2000, when I started my professional career, I used to drive around with, collateral in my trunk because that was how people got their information. That was well before the shift of information moved away from the vendors to the consumers or the buyers. Because now you can go Google or open up a GPT and just go find everything that you want. I don't know the latest numbers, but the percentage of folks that are X, Y, Z down the horizon of their purchasing decision before they ever talk to a vendor, it used to be like 5, 10%, 15, 20 years ago. And so even as that started to shift, there were even things like if I'm a value-added reseller, so I'm somebody that supports like corporate IT buyers in my region or where I live, or if I'm a small company just kind of in the city that I operate, if I'm a managed service provider or something like that. For me to stay up on all the trends and things that are going on, I oftentimes lean on my vendors. An example of that would be around, I'll get these dates wrong, but probably around 2008, 2009, even just in network cabling. We've all called a cable like a Cat5 cable. Well, there was Cat5, then there was Cat5e, then there was Cat6, then there was Cat6a, and they all had these different technological capabilities, how much data they could transmit, all that kind of thing. Well, if you're one of these 18 or 20,000 resellers, like how are you always going to stay abreast of that stuff? You lean on your vendors like Belkin at the time. So it's like empowering them, enabling them, and really good account management then. You ask yourself the question of like, what does good look like? Good looked like you being the person they would call when they needed help because they know you'd deliver, they know you knew your stuff, and you were going to help them more successful with their customer. And they called you instead of calling your competitor. Because that business was really a market share business. Share shift, how do I
super
take
commoditized?
100%. So how can you be a better partner by better managing that account to help them be successful?
And so pretty hands-on, pretty involved. You're working with people. You're in a more commoditized environment. Then you switch into the SaaS and software world, where instead of being there saying I'm building these really long-term relationships and I'm providing a certain level of kind of baseline value for my customer. A lot of the modus under the SaaS world is I've got a renewal, right? Because my time cycles have shrunk down. So now I'm doing renewals every 12 months or 24 months or whatever it is. And that's how I'm viewed as an account manager. Basically, did you get your renewal or not? And then at some point, people start to say, what about expansion? And that gets added in there as well. So how does your lens start to shift for you as you went through that transition?
Great question. I'll use a couple of terms that were pretty common for us kind of in the hardware universe and then apply it to software. In the hardware, like let's just call it the distribution model universe or the channel universe, we used to use multiple different terms. One was sell to, one was sell through. Sell to is the idea of going and finding a new distributor or a new reseller who would then go offer your products to their customers. So if I'm going to go, if I'm not doing business with Alex Co. and I want to compel him to use my type of hardware products or software in some cases, I need to sell to him or her, him in this case, to add me to their line card or be willing to go offer my wares elsewhere. And then sell through is the partnership of selling that product together through Alex Co. to the end user. The big fundamental shift between a largely channel-driven organization, or like what a lot of hardware businesses look like and still today look like, and software is almost every transaction is sell to. You don't sell it once and then have people go and proliferate the ability for you to sell that product through. Every one of those engagements is selling to. And then every time you have a renewal, it's almost essentially like you're having to sell to that consumer, whoever's not technically consumer, but whoever's consuming or buying your product again, the end user. And those are essentially just higher stakes. Every single one of those opportunities is you're either going to win it or lose it. In a one-to-many kind of distribution relationship, if you will, you're going to win some and lose some, but there's so much velocity there of the sell through that as long as you can stay steady state and you get that phone call more frequently than your competitor does, you're going to have all the at-bats that you need. In software, where you're selling a contract, you've got one at-bat for that particular buyer's decision. You've got one at-bat for that 1 year or 3 year commitment they're going to make. And then, if it's 1 year for the next, 8 or 9 months, you got to go make sure that they give you the next at bat. There's a lot more intensity on each one of those customer relationships because each one of those contracts holds some certain value of ARR, and you need to renew it and make sure that your GRR stays intact. And then obviously you want to continue to layer on that from an expansion standpoint for NRR, et cetera. But each one of those is markedly a little bit higher stakes.
All right, so just do us a quick favor here, Cliff, and define ARR, GRR, and NRR.
Yep. ARR, the way I break it down as simply as possible, it stands for annual recurring revenue, most often used in a software universe where somebody's buying from you based on a subscription. And that is the dollar value that somebody has committed to purchase from you on an annualized monetary basis. GRR is gross revenue retention, sometimes interchanged with GDR, which is gross dollar retention. Gross revenue retention means of the dollar amount that you started with at a customer, let's say like you're selling a per seat solution or a transactional based solution, either a customer or a specific set of customers. How much money were you recognizing in revenue at the start of whatever period you're looking at versus how much is still around at the next time that you measure it? So if you start with $1 million of revenue across these 10 or 20 or 50 or 100 accounts at the beginning of January, and at the end of January, you are now at $900,000. You've lost $100,000. So your gross revenue retention rate would be 90%. Net revenue retention means once you calculate the gross revenue retention, there's always the opportunity, and part of the key goal of account managers is to find expansion and upsell opportunity. let's say in that same example, you started $1 million, you're down now to 900, but for that same set of customers, you added $300,000. They might have churned or stopped purchasing some amount, but they've bought into some other amount. So 900 plus the 300, your NRR or your net recurring revenue would be $1.2 million in that example. So net recurring revenue represents not only shrinkage, but also the growth within an account or set of accounts.
Awesome. All right, cool. I like explaining those because we throw these terms around all the time, including inside the Amplify community, and it's just good for us to have an idea of what we're talking about here. Well, I want to kind of collapse time a little bit and fast forward because you then went through this this career where you were in account management. You went from hardware into software. Then you had a lot of different sales roles, and then you were able to climb up the leadership ladder to become an SVP of sales and then eventually become a chief revenue officer. One of the things that is super important and we want to get into on this episode, I know a lot of people are very curious about this, is how does the CRO manage the multiple claims on their time, energy, and focus? Specifically, one that gets a lot of attention is forecasting. Okay, so when I think of what's the role of the CRO, it's funny. We had the guest on the podcast recently, Craig Rosenberg, and he said the CRO is someone that we look to run through walls to get revenue every quarter. So that's part of it, obviously. But another part of this is to bring some predictability into the business, and specifically to be able to set a forecast at the beginning of the quarter or the year, and then update that and hit that. That's big. It's a big deal. It's high stakes. It's something you've got a lot of experience with because you've worked for a whole variety of different companies, different ownership structures, PE backed, venture capital backed, et cetera. So, but I can just feel that this is a really big part of the job. Now, walk us through how, as a CRO, you start to think about forecasting. To what extent, your mind is thinking of new opportunities versus existing customers. So like net new business versus the NRR that you were just talking about. Like, let's get into that a bit.
Yeah, you bet. It's a really thorny topic. You didn't shy away from the pressure cooker that can sometimes come with the role, particularly with regard to forecast. I'll preface all of this by sharing something that I share with my teams, my leadership team, up and down the organization frequently, which is job number one in this, as a CRO or a revenue leader of any sort. Job number one is hitting the number. That's what we get paid to do. That's why we're here. They're not paying us, because we have great thoughts. They're paying us for action and how those thoughts turn into meaningful outcomes. Job number 1A, however, is to be accurate. Job one, hit the number. Job 1A, even if you're not going to hit the number, you better darn be accurate as to what's going to happen, because we're running the business based on what happens in, bookings, revenue, retention, all those things. So, I've not been in a CEO position before. If somebody's, largely missing their number, but they're really, really accurate at 68% of their number, they're probably not going to last that long. But if somebody's largely near the number, plus or minus, 96%, 102%, 97%, that kind of thing, but you're accurate and dependable, it's got a lot of legs on it. That's a really, really valuable place to be, particularly for, a company that's not break even, whether it's debt financing, equity, either private equity or venture capital, as you mentioned, because the capitalization of the business prior to being break even and supporting yourself is really, really important. It can be really expensive. It's a really critical strategic part of the business, et cetera. So just preface it, with that, job 1 and 1A. Forecasting feels really, really high stakes, and even more so high stakes in, startup or scale up type environments where you may still be in that triple, double kind of first 4 or 5 years of a business, or even beyond that, where you're still expected to grow, namely top line, 15, 20, 25, 30, 40, 50% a year, which is still pretty ambitious depending on what you're selling. I did a session with the Rev Forecasting Summit a few months ago, so I pulled up some of my notes from that because there's some takeaways here that I thought would be valuable to share. In 2024, only 20% of sales organizations achieved a forecast within 5% of their results.
All right, so last year, Only 20% of companies got within 5%
actually
of what
got
they
to the
said.
number within 5% of what they said they were going to do.
Okay.
Right. It's a really low percentage. So 80% were more than 5% off between forecast and results. Over 50% of revenue leaders missed a forecast at least twice in the prior year. Right. So if you're in a high velocity business, you're probably forecasting monthly. More down the middle business, probably quarterly, no less than quarterly. Over 50% of revenue leaders missed a forecast at least twice in the past year. So if you're doing quarterly, you were 2 for 2 or 2 for 4, right? 80% of sales organizations have a forecast accuracy less than 75% to the number that they hit. So if you were forecasting $10 million, over 80% of sales organizations are either going to be at 7.4 million or blow out that 10 million by another, 20, 25%. So just markedly off, which is a better problem to have, but still a problem to have. And if you're a CFO, you might think, and earlier in my career, I think like, oh, but if I just go crush the number, like, why is anyone going to be upset? Because if you're in a growth company and you're the CFO, you want to know that money's coming so you can be investing it to accelerate your growth. You don't want surprises where you could have invested 3 months ago, just the same that you don't want surprises because maybe you need to start cutting expenses 3 months ago. So that was actually a really hard concept for me to understand earlier in my career, which is like, if I just crush the number and blow it out, why is everyone so upset? Because there's opportunity cost to not knowing you're going to have that money to spend. And then
Presumably
finally,
it then trickles down to you, for example, because you're not hiring the team, you're not allocating the
all the
portfolio
things,
like in the way that you optimally and so on, right?
all the things. If you're accelerating your revenue growth and you're in a growth company, that's not profit you want to take off the table. You want to reinvest. And if I'd have known I was going to have an extra $2 million in December to reinvest back in October, I would have invested it and we'd be a quarter ahead for the following year on having more staff or spending more on marketing or investing in product or a whole host of things you can invest in. So it's not as bad a problem. Trust me, anybody who wants to be a CRO, if you blow your number out and you're wrong, cool. That's a much better problem to have than being way short. But still, in just good business process management, it's a miss. Finally, to the core of your question, as many as 80% of executives say that forecast misses impact board and investor confidence for many of the reasons I just spoke about. So it is high stakes. When it comes to like, how do you thread the needle? Unfortunately, when you have to deliver bad news, it's more challenging, as you can imagine. The number one thing that I share with people about forecasting and the high stakes forecasting, particularly in front of the board, or if you don't work for a smaller company, but in front of whomever you report to or your department reports to, deliver bad news early and often if needed. For anybody that's read Chris Voss's Never Split the Difference, he talks about how you can disarm people, and even some of his podcast information and things, he talks about how you can disarm people, and it's actually a sign of kindness to like tell somebody you're going to deliver bad news. I was in a negotiation with a customer a few months back, and we had to unfortunately tell them we weren't able to build this particular integration they needed for their workflow. And at the start of the call, I said, hey, Gina, before we get going here, I just want to tell you this is not the call you're hoping for. We need to let you down, unfortunately, and tell you we're not able to deliver some of those things. But I just didn't want you to get surprised by that 5 or 10 minutes in. And at the end of that call, she literally thanked me for like giving her that heads up and allowing her to prepare for that. So one, deliver bad news early, deliver it often if needed. Unfortunately, it can feel like death by 1,000 paper cuts, but I can assure you that leadership or your board doesn't want to hear about something once it's already in your board deck. So whether it's you, any of the folks listening here, whether it's a CEO who has pretty regular contact in between board meetings and things with board members, like send the flag, tell them what's going on. The challenge with board forecasting or high stakes forecasting is you want to manage risk without eroding ambition. So like, how do you deliver truth without sounding like a pessimist or that you can't do it or that there's not optimism? So how do you balance reality with optimism? It should always be put in terms of like challenges and opportunities. These are the current challenges we see, but we still have the following opportunities, and these are the things we're pursuing for the following reasons and why, and here's how we're going to know if we're being successful, how we're going to measure things, etc. I think it's really easy to paint a broad brush about a board or an executive team, but really important to understand your board, your executive team. What are the dynamics? What do they care about? What are the types of questions? You'll see pattern recognition over the course of conversations, board meetings, et cetera. What are the things what slide do you always get stuck on that they spend 35 of the 60 minutes on? Because they're really passionate about that. Oftentimes it's a financial slide, but there could be other things. You have a board that's really focused on product roadmap because they think delivering products and shipping products is the path to solving problems. You have a board that's really focused on pipeline. You have a board that's really focused on retention, particularly as it relates to account management, either gross retention, net retention. What do they see as kind of the North Star for future successes? And then your executive team being aligned. So the nuance of your board and your executive team is really important. And then finally, I would say strengthen your data sources so that you can continue to reduce surprises and fire drills. If you build the right systems and processes for anything you're doing, right? The goal for any of us, particularly those that are either in leadership or aspire to leadership, the goal is to build repeatability. Repeatability comes from data systems process. And the degree to which you continue to refine those, you're just going to be operating with better information. And those peaks and valleys should just start to narrow a little bit.
Mm-hmm. Okay, got it. All right. So this is what I'm hearing, that forecasting is very important just for the mechanics of the business. It's also very important for your personal credibility as a CRO and as a leader,
100%.
because if you're on target, then people say, oh, this person's competent, they know what they're doing, we're going to give them the benefit of the doubt, we're going to stick around. Even, by the way, if we're under our number, at least if we're being accurate about why and what's going
They
on,
have a handle on it.
and we have a handle on it, then we're buying ourselves more life. If we blow over our number, okay, great, wonderful. It'd be nice if we knew that ahead of time, but no one's heads are going to roll, if we're way over our number. But if we're under, and then if we're under by high variance, then people are saying, hang on a second, does this person even have a handle on the revenue function?
Right. Do they know what we're going to do about it? One of the things you said a few minutes ago about the prior gentleman who said they hire the CRO to walk through walls to figure out how to hit the number.
Yeah.
Depending on the scale of the business you're at, I would tweak that a little bit. My point of view would be the CRO's job is to build a team of people who will walk through walls to hit the number. And that's often a common misconception of either the stage or at which you're ready to hire a CRO or the role of the CRO. And I recall having the conversation with Dan, the founder of Snapped, when I joined about 2.5 years ago, to just calibrate on exactly that. Are you looking to hire a VP of sales with a CRO title, or are you looking to hire a CRO? Because it was really, really important. And they had not had a CRO in the business before. And Dan was a first-time founder, so it was really important to calibrate. And I went further to say, I'm not going to know what's happening with the next deal the way I see the role of CRO, because that's not my job. The VP of sales will. It's their job. The director of sales will. It's their job. But you don't want me at that level of altitude, of course, at times, but exclusively because then I'm not thinking about the business and thinking forward. So from my perspective, the CRO's job is to build an army of people who are willing to walk through walls and will get the job done to hit the number. But back to what you just said, the credibility piece is huge. A VP of sales who continually blows out his number is more acceptable because their job is to just walk through walls and go hit the number. A CRO who continually gets the number wrong, there just is an acumen and an understanding of the business that you'll get holes poked in it, and there'll be you'll diminish some confidence.
Now, when you're working on the forecast, when you're looking at this and you're trying to think, where's our business at? And this is important because I've been seeing a lot of account management teams rolling up under the CRO. And personally, this is where I think they belong. Okay, so I'm just going to say very clearly here,
would agree.
I believe that the account management
is not customer success.
Totally.
Account management is a commercial function.
Yes, correct. So I believe that it belongs under the CRO. You can call it the growth function, the account management, whatever it is, but it belongs right there under the CRO because it is revenue. So when you're looking at your forecast, and if one of the major things is confidence in the forecast, I presume that confidence in the forecast, especially on the existing customer side, comes from how are we doing on our renewals, leading indicators toward renewal, all that sort of stuff, what expansion opportunities that we have. And I would guess that most of the variance in your forecast is, hey, do we have this new customer? Is it going to happen this quarter or not? And that's a lot more variance, but you're relying on the account management team to have basically like a floor of revenue every quarter. Did I get that right? Like the way that most people think about this, or the number that I've heard a lot, to put it this way, is something like 71% of revenue comes from existing customers every year. So 29% comes from new business, 71% comes from existing business. Okay, great. Those numbers are going to vary in company by company, but broadly speaking, that's true. So you as the CRO are sitting there saying, all right, I've got a stable of revenue from my existing clients, most of the variations coming from new business and potentially surprise churn. This is my guess. How do you start to think about that?
The first thing I would suggest is it's important to break, and particularly for the folks listening, it's important to break down the difference between revenue and bookings.
Yeah.
Because a lot of people just kind of commingle those. Revenue is the amount of money you're going to bill or have billed to the set of customers that are paying you. And bookings is the way I think of bookings. Bookings is the new business, not necessarily like a new customer, but bookings is the revenue that you didn't previously have that someone has now committed to pay you in the future. You're the 71% you said?
Yeah.
The 70 from a revenue standpoint, that probably, I have no reason to challenge that. I think based on the size scope of the business, the types of contracts you have in place, are they month to month? Are they annual? Are they multi-year? There's probably some variance there. But once you have particularly in a software business, or even going back to my hardware days, like we're going to ship a number of boxes because we just know there's like I'd call that run rate, right? When we were at Belkin, we knew we were going to ship, however many tens of thousands of cables a month because that just was kind of the dynamic of the market. Great. So we can count on that $3 million a month or $6 million a month or whatever the heck the number was. And then there's how are we going to go out and find those new end user opportunities? And what's that going to be? And those are pretty lumpy usually because we're not getting involved if it's a onesie twosie. But where there's an opportunity and then maybe there's special pricing and someone's doing a new data center project, great. Well, then that's going to be another $500,000 boon to that month that we didn't previously have. That's above run rate. In the recurring revenue model, it is fairly the same. What customers are currently contracted that are either under contract or they're going to continue to pay. And then which ones did you bring in last month? They're going to start billing this month, and it's bottoms up. And then which ones are you going to bring in this month? They're going to start billing next month, and that's kind of how your revenue curve grows. From a revenue standpoint, in the absence of some really high churn business or really sporadic or seasonal business, that sounds directionally accurate. The way we have traditionally, or at least most recently at Snap, the way we would build that forecast is Snap was a really interesting business. We sold in the multifamily property space. And that industry, more than any other industry I've been a part of, has really distributed decision making. So at Snap, we work with customers like Greystar, Cushman & Wakefield, the largest property management companies in the country and arguably the world. And while you might be an approved vendor with them, the property manager or the regional manager that manages a handful of apartment buildings on behalf of like an ownership group, they're empowered to kind of make decisions that make sense for that market, for that owner, for whatever their process is. So Snap, as an example, had about 500 customers across like 7,000, 8,000 properties across the US. And Snap was really interesting because largely a lot of those contracts were month to month. So we had built into our mechanics, hey, there's going to be a certain amount of churn that's just because of the nature of our business, and it's really transactional. Cool. So our GRR was naturally going to be just a little bit sub 100 because of just the nuances of that industry. One of the nuances of that industry is change of management, where someone will choose to move from Greystar and go to Cushman & Wakefield. So they'll shut off using Snap there, oftentimes turn it back on, but that was just going to happen. Technically on the P&L, though, that's churn.
Yep.
So we would look at, hey, what business is going to stick around? We would look at the sales side of things. What new conversations are we in? What's the forecast on sales? And everybody thinks of forecasting and sales is pretty straightforward to think about. What's the close date? What's the probability? What's my commit category? Is it going to happen by 7/31 as an example? Okay, we can add up what we think those bookings are going to be in the period. But then also, what are the expansion opportunities we're working? And that's the role that account management plays, which is the customer satisfied? Yes. Have we been doing all the things? You used the term leading indicators earlier. Do we show the right leading indicators that it's the right time to ask this customer for more business? Really nuanced thing. That's part of the art of things of account management. If so, what can I expect? What's our strategy to go expand at that account? And then sort of the same type of lens as sales. When is that going to happen? They have a critical event. What's their current pain? It looks much like a sales cycle. It's just different because it's not the first conversation you're having with that customer. You're probably not having to go through like a new paper process. You're not having to learn who the decision makers are. But if you're adding and providing value, you earn the right to go expand revenue with them. Jocko at Winning by Design coined the term recurring revenue comes from recurring impact. So if you're having recurring impact, great. Then how do we ascribe an amount of recurring revenue and expansion revenue to the work we're doing for that customer? But it's 4,000 times more complicated than what I just said in 2 minutes.
Well, yeah, but what I'm hearing is you're building a system to create the forecast for the existing customers, and you want to be able to look at this and say, okay, there's a large portfolio of clients, and everyone's in a different stage, and everyone's in a different state, et cetera. But we have a general sense that if we're running a system and we are disciplined about that we're
here's what our run rate should be.
Yeah.
And then what are all the things we're doing to change that curve?
Right. Okay. And then therefore that's going to give us confidence in the forecast itself.
Correct.
What do you do as the CRO, as the leader, when the existing business forecast is off? Without
using expletives? From my perspective, it's diagnosis. If in addition to kind of the job 1A that I shared earlier, the other thing I'll often share with the team is we're going to have customers churn. We're going to have customers surprisingly show up and expand as well. But I think in this context, it's, unfortunately, it's more frequently like you get surprised. What we're constantly working on over a long time horizon is to just eliminate or reduce those surprises. We're going to have customers churn. That's okay. We're potentially going, I say on the sales side of things, we're potentially going to lose because we don't have a certain feature or because we're not priced right, or because the customer for a different reason chose to go with someone else. But it's not okay for us to lose based on sales execution. If we drop the ball, if we don't run a good sales cycle, if we're just not, running our system well, that's an unacceptable reason to lose. Like getting ghosted or the lost touch or they didn't respond, like that's on us. If, hey, this other solution had a feature and they went that direction and our team hasn't built it yet, like that's okay. We did our part of the job well. On the renewal side, similar, it's okay. I mean, you don't like it. Customers are going to churn. It's the ones you get surprised by that are the not okay ones. So what we regularly try and do is diagnose if we do get surprised, what took place. And then again, going back to what you said, what are the right leading indicators that should have told us 60 days ago or 90 days ago or 120 days ago that there's a problem here? Because only once you diagnose something can you actually fix it. And all of this is like a flywheel into perpetuity. Everything can continue to get refined. I don't know any CRO, account management, or CS leader, sales leader who will ever say like, oh, we have our forecasting system down. We don't ever need to do anything again to it.
Well, I'm reminded of what you said at the very beginning. You said bad news early and often. And so that applies to all the account management leaders, all the account managers out there. If you see something coming, raise the flag, get it out there. Even if it's just an early warning sign, you should be managing a very disciplined process for a risk register. You should have a meeting that just covers the risks within your portfolio.
Mitigation playbooks,
all that stuff. You should be doing that. If you're not doing that, it is not okay to walk in and say, "Whoops, no one ever saw this coming. I didn't tell you, but we just lost a $250,000 client who's terminating next month." That is not okay at all.
That is not okay.
That is not okay.
Unfortunate, but. Hey, remember that customer that we mentioned in March and we put that Tiger team together and we got Dan, the CEO, involved to do some executive sponsorship, which should have been happening anyway, but like it is what it is, right? If people swarm, you raise it, you do what you can, you create some prescriptive plans to try and reverse course. And then I have an update in July that says, unfortunately, we're now at the end of the contract period and the customer let us off the hook last week and told us they really appreciated the effort, but they're still going to move forward and change vendors. Still stings, but it wasn't for lack of action and it wasn't for suffering in silence. And that's okay. Those things are going to happen.
It's not a career altering
that's not a
event
career
for the
limiting
account
move.
manager. Yeah.
Yeah, exactly. Now, you can't be, you also can't be that account manager that every time someone's grumpy on the phone, you raise the flag and go, oh my God, I think the sky's falling.
Yeah.
But that's why thoughtfulness and combining, the subjective pulse that an account manager or a customer success manager has on an account, which cannot be overlooked, with hopefully some level of like hardened systems, KPIs, leading indicators, usage metrics, the curve of what's going on in that account. Like the objective and the subjective are the only thing that can come together to really kind of paint the right picture.
So this is awesome because you're giving us a really good window into something we don't talk about all that often, which is forecasting. Last question I have for you is, how does an account management leader, right? So the director, team, VP, SVP, whatever it is, make your job as the CRO easier?
This might sound trite, but leveraging the systems and processes the way they're built is probably the number one thing that the leader and the teams can do. And the reason is data is king. The number of times throughout my career that I've had to have tough conversations with either individual salespeople, sales leaders, account managers, account management leaders, customer success folks about the importance of data for us to make decisions in the business, I would aspire counting the number of times. And the reason is we can only operate the business as well as the data we have. And the people that are best armed to get that data are the people that are talking to the prospects or the customers every day. So in one instance, I can recall trying to do close lost reporting. And I think we had 19% of our records that showed who the competitor was that we lost to. So I'm trying not only to prepare information for the board so they understand and collaborate with our product leaders so we understand what we need to build. I can't explain why we're losing deals because I don't have the information. Now, all those reps had it in their head or on their iPad or in Sanskrit or however they ran their deal process. And the number one thing is being a good internal customer and providing the information to the business. Look, it is a drag. And today there's a multitude of tools that will actually get that information into CRM for you. So I'm not asking you to block 3 hours every Friday and just go do the busy work. Find ways to do it efficiently. I will never ask anyone to do work just for the sake of doing work. But not having concrete data and fulsome data on what's actually going on in the customer conversation is probably the most painful for someone. Look, there's a variety of things that can be painful, but with regard to the internal team, the most painful for someone in my role. It's important to articulate to the people you're asking to do that work what's in it for them. So help them understand, look, the reason I need this information is so it can inform our product roadmap. So you're going to get more things that are going to resonate with customers. Or the reason I need this information is we're planning out next quarter's marketing spend, and I need to understand which leads are the best ones so we can actually go spend more money and get you more leads and get you more at bats and help you sell more. Help them understand that part, because just asking them to do work is a recipe for failure. It's poor change management. But integrity of data is one of the biggest things that will hang someone up in my role.
All right, so you heard it here first, folks, from the lips of Cliff Unger. Get your data in order. Work the systems that you have. You've got all these tools out there. You've got all this stuff out there that help you do your job better. Use that stuff and use that to get the information to your CRO when they need it. That's the best way to avoid any type of nasty surprise, both for them and importantly for you.
Your executive team wants to say yes. I promise you, your CFO, who everybody's always like, the CFO shuts everything down. That person wants to say yes if they have data that shows that they can make a good investment to grow the business. So give them the data and good things will happen.
Awesome. Great. Well, Cliff Unger, thanks for joining me. Great to see you, man.
Thank you, Alex.